Everyone knows IV ramps into earnings, but almost nobody realizes that most pre-earnings straddles are still bleeding money. We backtested more than 21,000 pre-earnings straddles, and the verdict was brutal. The ramp isn't edge, it's just math. But a small, filtered subset using only 4 signals completely changed that picture. It turned a break-even grind into a 7-figure out-of-sample equity curve without holding through the earnings gap. In this video, I'll walk you through the exact trade, the 4 signals that drive it, and why most traders piling into the earnings IV ramp are consistently losing money. Let's start with the actual trade so you know what we're talking about. We're buying at-the-money straddles into earnings, using the nearest monthly expiration after the earnings date. We enter roughly 2 weeks before the earnings date and exit before the announcement. So we're explicitly not trading the actual earnings gap. We're trading the repricing of volatility into the event. At a high level, this is a long volatility trade. We're long gamma and long Vega into a known catalyst. Positive EV long vol plays are rare. Most of the time, being long gamma is expensive. You're fighting time decay and usually paying a premium for that convexity. If we can find a regime where the earnings event is underpriced, any volatility pickup compensates for that decay. That's very attractive. Most options traders spend the majority of their time short gamma and short volatility through spreads, short premium, structured products, whatever. That creates a very specific risk. If the underlying or the market crashes or vol regimes shift, you're on the wrong side of the move. Pre-earnings long straddles can act as a targeted portfolio hedge. Even if the earnings event itself doesn't reprice significantly, a market-wide vol spike will generally push ambient volatility up. Since we're long volatility in those names, these straddles can offset some of the P&L hit from the rest of our short vol book. The other key property is we don't hold through the event. So we're not betting on the realized earnings move being bigger than implied. That's a different game. Here, the trade is long straddle into the event, exit before the announcement. Profit, or not, from how the implied event volatility and ambient volatility get repriced as earnings approaches. To really understand this trade, we need to separate event volatility from ambient volatility. Background noise versus the earnings jump. You don't have to crunch any of these numbers yourself. This is just the context behind the edge. If you've ever wondered where the implied move number for earnings comes from, I'll walk through it here. First, ambient volatility. Think of this as the background volatility of the stock if earnings didn't exist. It's the volatility you'd expect the stock to realize on an average day, given the current regime without any big scheduled jumps from earnings or other events. In practice, pre-earnings will use ambient vol to represent what the underlying is expected to realize on non-event days. Then we have event volatility, sometimes called jump vol. This is the one-day volatility specific to the earnings announcement, the expected size of that earnings day move. Mathematically, you can think of it as an extra one-day variance that gets bolted on top of the ambient background variance for that particular day. In the best case, there's an options expiry before the earnings date, so that expiry sees no earnings event. That near-term expiry's implied volatility is then a clean proxy for ambient volatility. Whatever IV the market assigns to that pre-earnings expiry is basically, here's how volatile we think this stock is without the earnings jump. We'll call that sigma ambient. Sometimes there is no expiry cleanly before the earnings date. Everything you see includes the event. In that case, we can estimate ambient vol using forward volatility between 2 expiries that are both after the event. The idea is, both expiries include the same event. When you isolate the forward vol between them, the event component largely cancels out. What's left in that forward volatility segment is a good proxy for background volatility after the event. Once we have an estimate for ambient volatility, we can back out the event volatility from the total implied vol for an expiry that spans the earnings date. Remember that variance times time is additive. If an expiry covers T days, and one of those is the event day, and the rest are ambient days, then sigma total squared times T equals sigma event squared times 1 plus sigma ambient squared times T minus 1. Here, sigma total is the annualized IV of the expiry that includes earnings. Sigma ambient is our annualized ambient estimate from the pre-event expiry or from the forward vol estimate. And sigma event is the unknown we want, the annualized jump vol for that one day. We can rearrange and solve for sigma event squared. Then we can take the square root to get back to volatility space, giving us the annualized volatility of the one-day event. Usually traders don't talk in event vol. they talk in implied move. That means the market is pricing a plus or minus X% move on earnings. We can go from the annualized event vol to an expected one-day absolute move as follows. First, we convert from an annualized event volatility to a one-day standard deviation by multiplying by the square root of 1 over 365. Then, if we assume a normal distribution, the expected value of the absolute move is the square root of 2 over pi. So in total, implied absolute move is equal to our annualized sigma event times the square root of 1 over 365 times the square root of 2 over pi. You don't need to memorize the constants, but this is how we get from event vol to the implied move number you see on a lot of earnings dashboards. Now that we've separated event vol from ambient vol, we can talk about the famous earnings IV ramp and why the ramp alone is not an edge. If you spent any time in options forums, you've probably seen the idea of buying the earnings ramp. The story goes, IV goes up into earnings, so just buy straddles early and sell them later for a profit as IV ramps. On the surface, it sounds reasonable. You're long Vega, IV goes up, your straddle gains. But it's not that simple. Go back to our ambient plus event picture. Imagine we're 20 days away from earnings. 19 days are smaller ambient volatility, and 1 day is the high event volatility. The quoted IV for that expiry is basically an average of the 19 ambient days and 1 large event day, converted into an annualized volatility. Not literally, since volatility isn't additive, but we can think of it this way to form an intuitive understanding of the effect. As time passes, we get closer to earnings. The number of ambient days in that expiry shrinks. The single event day is still there, contributing the same event variance. So the average shifts upwards. IV ramps. But notice that ramp is mostly a mechanical effect of dropping low vol days from the window. It doesn't automatically mean the event component itself is being repriced higher. In variance terms, the event contributes a fixed chunk of variance to that expiry. Each day that passes, we use up some ambient variance as it gets realized. We get 1 day closer to the event, and to pack the same event variance into fewer remaining days, the annualized IV must go up. So yes, annualized IV ramps, but the total future variance that the straddle can still monetize is actually shrinking. We're consuming it on ambient days, so the straddle will ultimately lose money. That's why a long straddle doesn't automatically have positive drift just because IV is drifting up. The underlying has also been moving, time's passing, and theta's burning. Let's look at this simulation that assumes constant event volatility and simulates time passing as IV ramps. We can see as time passes that the IV is increasing, but without the event volatility being priced up, the straddle will actually lose money over time despite IV increasing significantly. Now, let's look at a simulation that assumes the implied move increases from 4.2% up to around 7.5% as the event gets closer. In this case, we can see that because the actual event volatility rises, our straddle now becomes profitable. So in this strategy, we're not betting on the ramp itself. We are betting that the event volatility component, the implied move, will get repriced higher as we approach earnings. And to a lesser extent, that ambient vol is fairly priced or cheap and might also get marked up if the market realizes it's too low. The ramp itself is just a mathematical artifact. It is not an edge. The edge, if exists, has to come from mispricing of the event versus its history and versus realized outcomes. So that's the theory. To see if there's actual edge, let's look at the data. We built a large pre-earnings straddle dataset and stress tested this idea properly. To test this, we built a dataset of pre-earnings straddles. The universe consisted of liquid stocks with at least 20K average daily options volume at the time of entry. For entry timing, we opened the straddle as close as possible to 14 days before earnings with a tolerance of plus or minus 4 days. And we always use the nearest monthly expiration after the earnings event. We also estimate and apply commissions and slippage at both entry and exit. That gives us about 21,500 trades starting from 2009. First, let's look at the unfiltered strategy. Just buy every single pre-earnings straddle under those rules and exit before earnings. The return distribution is slightly positively skewed. The median outcome is around a negative 6.3% loss, and the mean is slightly positive, around 0.3%, with a win rate of around 37%. That shape, many small losses, fewer big winners, is exactly what we'd expect from a long volatility strategy. A slightly positive mean is interesting, but I wouldn't assume that's a free lunch going forward. It could easily be partly historical artifact. Next, we looked at a bunch of signals to see which ones actually explain returns. We tried standard metrics like IV percentile, term structure slope, skew slope, and a lot of earnings specific metrics. For this video, I'll focus on the ones that actually mattered, plus one or two that didn't, so you can see what a bad signal looks like. We have the skew slope with a linear relationship to return that is basically flat around 0.01, seemingly a weak signal. We have the raw implied move, that is the current implied move for that specific event. As one would expect, it has a negative linear relationship with return around negative 0.06, where smaller implied moves tend to perform better. We have the implied versus last implied ratio, which is the current implied move divided by the previous earnings implied move. It also has a negative relationship. The smaller the current implied versus last implied, the better the returns. We have the implied versus last realized gap, which is the current implied move minus the last realized earnings move, also negative. The closer the implied move is to or below what actually happened last time, the better. We have the implied versus average past implied ratio. That is the current implied move divided by the average implied move across all past earnings events. It also has a negative relationship. The smaller the current implied versus the average implied, the better the returns. And finally, we have the implied versus average past realized gap, which is the current implied move minus the average realized earnings move across all previous events. Also has a negative relationship. The smaller the current implied move versus the average realized move, the better the returns. To understand which signals are actually useful, we bucket trades into deciles of each signal and look at the average return per decile. What we want is something that looks monotonic. Returns steadily increase or decrease as the signal gets stronger. That's a sign of a clean relationship despite the noise. Here's skew slope. The decile plot looks kind of like a parabola. Middle deciles do better, extremes worse. Not really monotonic. This is what a weak or noisy signal looks like in practice. Now, here are the deciles for the other signals. They're not perfectly straight lines. This is finance, not physics, but they're mostly monotonic. Lower implied versus history, better returns. Higher implied versus history, worse returns. That's exactly the kind of shape you want to see before you use a feature in a model. A signal that works only in one regime is not very helpful, so we check stability through time. We split the data into 4-year blocks and redraw those decile plots for each block. What we see is the relative signals stay reasonably monotonic across time. However, the raw current implied move signal is much less stable and weaker. The deciles are noisier and the spread between top and bottom is smaller. Combined with the fact that I prefer relative value signals anyway, they give you context across names and regimes, we end up dropping raw current implied move from our final model. Before building a regression model, we also want to make sure we're not just feeding in a bunch of near duplicate signals. We check the correlation matrix between features, some moderate positive correlations, but nothing crazy, and the variance inflation factor, VIF. So a rule of thumb is a VIF less than 5 is usually fine, and greater than 10 is where people start to worry. Our worst is around 1.85, which is completely benign, so we're not too concerned about multi-collinearity here. Now the important part, does this actually hold up out of sample? To test that properly, I use walk-forward optimization with an expanding window. The process is as follows. 2009 to 2010 as the first in-sample window. We fit a linear regression using our 4 best predictors. Then we trade that model on 2011 to 2012 data. That's out of sample. Next, expand the in-sample to 2009 to 2012, refit the model, and then trade 2013 to 2014 out of sample. Repeat this in 2-year out of sample blocks. This mimics what you do in real life. Fit a model on the historical data you have, then trade it forward without accidentally letting future data leak into the past. Across all walk-forward windows, the coefficients change slightly, but keep the same signs and similar magnitudes. The out-of-sample correlation between predicted and realized returns is consistently positive, and the top minus bottom decile spread, which means longing the top decile, shorting the bottom decile, is consistently positive as well. So the model is not perfect. Nothing is, but it's reasonably stable and does have predictive power out of sample. Next, we look at the trades where the model predicts a positive expected return. So we filter all out of sample events to a predicted return of greater than 0 and look at the distribution again. What we see is the distribution is still positively skewed. That's just the nature of long vol, but the mean return jumps from 0.3% to 3.3%. The median return jumps from negative 6.3% to negative 3.6%, and the win rate improves from around 37% to about 42%. So we still lose more often than we win, but the winners are bigger, and on average, we get a meaningful positive edge. Based on these filtered out-of-sample trades, we can estimate a Kelly fraction. For this dataset, the Kelly figure comes out to around 48.5%. That sounds huge, but remember, this is a long vol strategy where the maximum loss is capped at the debit you pay. Kelly tends to be very high in those setups. In practice, I would never run anywhere near full Kelly on this, and more likely, I'd use a small fraction, like single-digit percentages of Kelly, to keep drawdowns and variance acceptable. But the magnitude of the Kelly number is still informative. It tells you the edge is non-trivial. Now let's see how this plays out in backtests. Each day, we take the top predicted trades until the portfolio is full. We cap per trade notional at 100K or 5% of the ticker's daily option volume, whichever is lower, to respect liquidity. We run backtests with different Kelly fractions, and here's what we see. All of them perform very well historically. As we decrease the Kelly fraction, Sharpe ratios improve and max drawdown decreases. So there's a trade-off between raw return and risk, but even the very conservative fractions look attractive. After all this, we're comfortable saying there's real signal here. It survives out of sample testing, and it produces a tradable strategy with reasonable risk characteristics. At this point, we refit the final model on all available data to get the live trading coefficients. I'll leave the exact coefficients in the download link in the description, or check out the full list of plays that pass the filter on OQuants. So that's the research. Now let's talk about how you'd actually implement this in practice. On any given day, the workflow looks like this. For each stock with an upcoming earnings event in the right window, compute the 4 inputs. We then feed those into the regression model and get a predicted return for the pre-earnings straddle. We filter to predicted return greater than 0, or whatever threshold you want, and then we rank by predicted return, and subject to capacity constraints, take the top trades. Building and maintaining that pipeline requires reliable earnings calendars, historical earnings implied and realized data, and a bit of code to keep it all synced. If you don't want to maintain that infrastructure yourself, that's exactly what we do at OQuants. We calculate these signals for you and provide a trade list. If you'd like to do it yourself, there are several sources online for earnings data, even some free with limited history that would be enough to come up with estimates of the average values. Once a name passes the filter, enter a long at-the-money straddle in the nearest monthly expiry after earnings. Because this is a long vol strategy with a relatively low win rate, I prefer to use a small Kelly fraction, which improves Sharpe and reduces P&L variance, something like 2 to 6% per trade. I also like to spread risk across multiple names rather than loading up on a single ticker. The holding period is simple. Enter around 14 days before earnings, plus or minus a few days, depending on liquidity, and exit the straddle before the earnings announcement. Ideally the same day, sometimes the day before, depending on liquidity and spread behavior. If implied move still seems very cheap relative to history, you can also choose to hold through the earnings event if you want exposure to the realized move. But the backtest was not done this way. You can also optionally delta hedge or gamma scalp during the hold period. That lets you monetize realized volatility into the event. But it also adds a layer of complexity and transaction costs, so it's not necessary to benefit from the vol repricing itself. A few important caveats. This is a long vol strategy. Expect lots of small to moderate losers and occasional big winners. The edge shows up over a large number of trades, not on any single name. Drawdown periods can last a long time before a big winner comes along. Looking at the backtest, it was not uncommon to have several months of drawdown before making new highs. To recap, we separated event vol from ambient vol, showed why the earnings IV ramp alone is not free edge, built and tested a pre-earnings straddle strategy on 21,500 trades, and saw that a simple model using relative implied versus historical implied and realized moves can produce a positive edge out of sample. If you want me to do a separate video going deeper into the walk forward process, the exact regression spec, or Python implementation, let me know in the comments. If you'd rather not build all the data and models yourself, this is the kind of thing we run at OQuants. Link in the description. Thanks for watching.